Afternoon. So welcome to another in our enterprise series. This afternoon we'll be covering how the US election outcome will affect the UK economy and business landscape. For those of you who, obviously lots of regulars on these webinars, but for those of you who are less familiar with who we are, Moore Kingston Smith are a top 10 audit, accounting and advisory firm, and we work with entrepreneurial businesses across all different business sectors, as well as not-for-profits and private clients as well. And we're part of More Global. That's an international network with presence in over 100 countries. So very well placed to help you with your international goals, whether that is into the US or Asia, Europe or elsewhere. So the ripple effects from the impact of the US election they'll inevitably be felt globally and will no doubt affect the UK economy and business landscape. And of course, that's going to come just a few days after Reeves's budget plans are revealed. So in this webinar, our panel of experts are going to explore the potential outcomes of the US election and offer insight into what this might mean for the wider global economy, as well as highlighting the impact on UK businesses. So my name is Esther Carter, and I'm going to be doing some very light chairing today. So I'm delighted to be joined by Russ Mould and Dean Quambo. Russ has 33 years experience of capital markets, having worked at Scottish Equitable as a fund manager, UBS Investment Bank as a sell-side analyst covering European technology stocks, Shares Magazine as a writer and then editor, and more latterly as AJ Bell's investment director, where he's responsible for providing content for customers and clients and helping develop the company's profile in print and broadcast and working with the investment committee. Dean is a partner at Armanino, who are part of the More Global network. And after spending 12 years in audit, Dean transitioned into a client relationship builder and helps numerous businesses and not-for-profit organisations achieve their goals. So a little bit of housekeeping. This webinar is for you this afternoon, so please make the most of the speakers and their knowledge that they have. So please do ask questions, but I just ask that you pop them in the Q&A function, not the chat function. Much easier for me to keep track of them in the Q&A function, and then I'll try and weave them into the speakers as we go along. And any unanswered questions at the end, I'm sure our speakers will get back to you privately. The session is being recorded, so please do share with any peers or colleagues or anyone who was unable to make it today. So to kick things off, AJ Bell Investment Director Russ Mould will take us through a short deck. Only short decks allowed. We're small on PowerPoint in these webinars. A short deck on the big picture issues that are shaping both how Americans will vote and how their decision would then influence the economy and the financial markets in both the UK and globally. So over to you, Russ.
Thank you so much, Esther. And yes, I promise it will be a very short deck. And these slides here are really more as an aide-memoire for you. Once this session is finished, if you wish to refer back to them on the big day on the 5th when the votes are cast, and on the 6th when we find out the results. So if we pop on to the next slide, please. Sorry about that. Let's just get the all-important disclaimer out of the way. It keeps my compliance department very happy and helps them to sleep at night. The next slide again. So here we go. So will we get the 47th president of American history in Kamala Harris, the current vice president for the Democratic Party, or will we go back to the 45th with ex-president Donald Trump, who would be the first since Grover Cleveland, I believe, to make a return to the White House, having managed to lose one election. Now, there's only so much the president can perhaps do. They do need help from Congress, and clearly it's going to be just as important not just who wins the presidential race, but who wins control of the House of Representatives and who wins control of the Senate. At the moment, I think the Republicans have got the House and the Democrats have got the Senate, albeit with razor-thin margins. Well, whatever the candidates are saying, it'll really be they'll need a big sweep if they want to get everything done that they wish to get done. And if you get a divided House, for example, or the House going one way and the Senate going another, that will potentially rein in some of their policies and make it harder for them to achieve what they wish. However, things that presidents probably can have some say about to varying degrees: taxes, trade, regulation, and to a degree monetary policy, and we'll come back to that last. So where are the candidates in general terms standing here? What's the choice being put in front of the American people? And I'm sure Dean will have some strong views on this as well. We're all very aware that ex-President Trump is looking for lower taxes, extension again of the tax breaks he put through in 2016, and a further cut in the corporation tax are keynote policies. One source that he will seek for funding there is higher tariffs, not just on China, but more generally, but with China perhaps getting the brunt end of it and the most punitive tariffs, generally seen as a deregulatory influence. And monetary policy is the interesting one. He did give the Federal Reserve a pretty hard time during his first term, consistently calling for looser monetary policy. And one would expect ex-President Trump to do something similar this time if he gets the chance. Vice President Harris, an increase in corporation tax is one of her keynote policies, along with wealth taxes, and they will be used to fund specific credits and subsidies in areas such as childcare, healthcare, and housing for first-time buyers. I've seen some numbers bandied about by one or two broking houses suggest that both would add to the deficit, but actually President Harris's plans, when fully costed, may cost less. But again, these things are a bit of a tricky one. Vice President Harris seems to be on the same page as ex-President Trump in terms of higher tariffs. The Biden administration has not rolled back Trump's tariffs on China. In fact, has extended them in some areas. So we could probably expect more of the same there. Regulation probably seems to be more an interventionist tone, as you would perhaps expect from a Democratic candidate. This talk of price caps and price gouging, how on earth such policies can be implemented. In principle, you would argue that price caps tend to deaden supply and therefore could be not as helpful as the vice president might think. And monetary policy, a discreet silence. I mean, if you were to therefore summarize the policies, you'd kind of feel that both point to higher deficits, and the possible outcomes initially one would expect: Trump inflationary, Harris inflationary / stagflationary. I put stagflationary in there as a personal opinion, just because of the issue of price caps and how it may potentially choose to choke off supply. So that's how markets at the moment, I think, are looking at these things. Equally, I must stress that President Trump was widely thought to be a negative influence when he won in 2016, and actually US equity and bond markets did pretty well first time around. So we need to be a little bit careful about being too dogmatic, particularly when we really don't know who's going to win. I gather it's going to come down to 5 or 6 key swing states, all of which are too close to call, even if at the moment Trump seems to be slightly edging ahead in the polls. So that's kind of the policy options. The one thing that's not being discussed too widely is on the next slide: the deficit. We've heard lots of talk of policy initiatives, tax and spend, and how initiatives will be funded, but net, the US deficit continues to rise. And intriguingly, under President Biden and Vice President Harris, it looks as if the US is going to add around $7 trillion to its deficit in a 4-year period. It took America until 2003 to accumulate a $7 trillion deficit. That's pretty good going. You could argue that with COVID and lockdowns, there were some very special and extenuating circumstances there, but the Biden government has continued to pour on fiscal stimulus ever since, with the result that debt to GDP is now 100% and rising. And depending on, again, whose forecast you believe and who wins and what you think they might be able to achieve, some estimates have got that figure going to 130 or 140% by the end of a Trump second term or a Harris first term. The real impact of that is that the actual interest bill is rising. It's now at $1 trillion a year annualized, which, given that America spends $900 billion a year on defense, is not, you would think from a geopolitical standpoint, a particularly good idea. And I say that as a history graduate, particularly at a time when hot and cold wars are raging around the world. And particularly challenging is the maturity profile of US debt. As you can see from the chart in the bottom left-hand corner here, something like 40% of treasuries mature in the next 2.5 years. So really, the Federal Reserve has got every incentive to try and get interest rates down to help the government manage the debt and actually have some spending money left in the kitty. Now, financial markets are doing a relatively good job of ignoring this. Admittedly, the fixed income treasury market is just starting to show the first signs of interest. Since the Federal Reserve's first cut of this cycle last month, the 10-year yield is actually up. So somebody's getting a little bit nervous in bod vigilante land. But the other way in which financial markets may be voting with their wallets is in the gold price. Just look at how the gold price and the US deficit do seem to have a bit of an uncanny relationship, even if we must accept that the past is no guarantee for the future. And if the deficit does begin to blow out, maybe the gold bugs will start to have a little bit more of a willing audience perhaps they've had until very recently. So next slide, please. So the candidates have set out their stalls. And okay, over time, we all know the US market has been a phenomenal value creator. On an average of the average presidency that the market gains. Now, the average gain under a Democrat, for whatever reason, is better than it seems to be under Republicans. I would guess going further back, you would argue that maybe Republicans were seen as a little bit more hair shirt When it came to fiscal policy, we're a little bit more restrained. But, you know, I haven't seen the film The Apprentice yet, but having read the odd book on Donald Trump, and Dark Tower and his relationship with Deutsche Bank is just on the shelf behind me, he doesn't strike me as being a particularly careful person with his own money, let alone anybody else's necessarily. So I'm not sure that will apply perhaps this time. What's interesting, if you do look at specific presidencies, the best gains were these three here: Clinton's first term, Reagan's second, and Obama's first. Those terms all started after a recession when sentiment was depressed and valuations were low. The four down presidencies that we saw, Nixon, Ford in the mid-70s, Carter in the late 70s, and both of George W. Bush's presidencies, well, the first two would be deviled by recession and inflation, the second by recession and also the bursting of bubbles in the stock market. And that they started at a time when valuations were very high, as you could argue they are now. So it's not just where we are, but where we start from that's particularly important. Next slide, please, Ollie. And just what does this mean for the UK? Well, it's vitally important. Let's not forget, America is the world's biggest economy. So where the US tends to go, the world on balance is going to have a pretty hard time going in a different direction. America is the UK's #1 export market. It's #2 source of imports. And the UK at least is starting to come out of a recession, even if there is still some lingering concerns that the US may be about to slow down for a very lengthy period of growth. We've got the same debt dilemma here that they're facing in America. And look at the flack that the new Labour government's already getting for talking about tax rises, cutting winter fuel subsidies. It's already proving to be quite a difficult political discussion. At least the one thing you've got in the UK's favour is on a big discount to the US in terms of equity market valuations, and is closer or below historic norms, whereas the US is probably a little bit higher. And the one thing you perhaps could see is if we do get a bit of economic growth in the UK and indeed worldwide, perhaps powered by the US, the UK is not a bad way of playing that on the face of it. If you look at the mix of the FTSE 100's earnings, A, 2/3 of its earnings come from overseas anyway, and B, it's pretty heavily geared into financials, commodities, and consumer discretionary. Big, you could argue, relatively cyclical sectors. So the UK, intriguingly, if you get a bit of growth and a bit of inflation, might not be the daftest place to be. The US has probably feasted upon a low growth, low rate environment where tech stocks have been at a premium, and that's clearly played to America's phenomenal strengths in that area. So that's a little bit of a backdrop in terms of policies, options, how the markets reacted previously, and what it may mean for the UK.
Thank you very much, Russ. So, I mean, given all of that sort of context and background, what chance do you think there is of a US hard landing in 2025?
Gosh, if I knew that, I promise I'd tell everybody, because it'd make everybody extremely wealthy, potentially. I think the one thing I can say with certainty is that a recession is not expected by financial markets. The markets are pricing, bond and equity markets are pricing in a cooling in inflation, a soft landing, and lower interest rates. And at the moment, that is kind of playing out. You know, you've got a CPI prints moving back below 3% in the US, below 2% in the UK today, remarkably. The UK has come out of a shallow recession. The Atlanta Fed is still predicting 3% US GDP growth annualized for this quarter. And we've had 140 interest rate cuts worldwide this year, with the Fed in the UK joining the party. So that core scenario is happening. So if anything goes wrong, I guess, is what we need to be interested in then is, does inflation run hotter? Does the economy turn softer? I guess they're your dangers, because right now there's no way that a hard landing is priced into equities, or dare one say US Treasuries or UK gilts either.
I mean, Dean, just coming to you, I mean, given this of the impact the deficit in the US economy has had, what are people thinking about taxes in the future?
Yeah, Esther, that's a good comment. And Russ, those were great sides. Our deficit is really large. And what people are saying is we're going to have to pay for it sometime, right? We're going to have that deficit is going to have to be bridged. So either we're going to have higher taxes in the future, or we're going to have big cuts somewhere, but somehow that deficit is going to be bridged. I think that you kind of saw in some of your slides that that there's different ways and different thinking of how that deficit is going to be bridged, for sure.
I mean, how are we going to reconcile or how can we reconcile a hard landing to the fact that the US stock market is actually nearing an all-time high?
Yeah, Russ, I mean, you just said it like everybody is pricing in this soft landing, and this has been the talk of every business podcast here in the States for the last several years. Is we've had this extremely fast increase in interest rates to make for this soft landing, Russ, and here we go. Here we go. Is it actually happening? Is the question, and you see it. We're at all-time highs. Esther, I tell you, a lot of that is around the investment in AI. We're seeing that all over the place. You see NVIDIA and the amount of back orders they have and the orders that Google and Meta and Microsoft, just to name a couple of the companies that have big investments coming down the horizon. And everybody's seeing this as the next and maybe even the largest revolution. Like, if we had the industrial revolution and the internet revolution, is the AI revolution the next one? And its impacts are actually trickling down to other sectors as well, including energy. So that's why you have this sense of optimism in the marketplace for sure.
Yeah, I mean, it's interesting that, I mean, as I said, the Labour government here in the UK is wrestling with the same issue, having inherited this problem from the Conservatives. Is, how once your debt to GDP ratio goes above 80% or 100%, you're faced with interest bills that are draining money away from the economy, what you'd argue is more productive investment. And we can see it's already proving a very difficult discussion for the Labour government with the 30th of October budget in mind. They're catching flack for talking about cuts, they're catching flack for talking about increasing taxes, and it's really not easy. If you look historically, and somewhere on here, Reinhardt and Roggo's book, This Time It's Different, is behind me. Your options when you get to this sort of debt to GDP level are the best way is to grow your way out of it. And that's clearly what any candidate will try and achieve, and why Labour is talking about this growth agenda that we have, even if it involves rewriting the fiscal rules to give them some breathing space and some spending money. If you can't do that, and let's face it, if we could pull a lever and turn up growth, then believe me, we would. It isn't as easy as it sounds. Then you're left with an option of inflation, or you're left with the option of default. Well, the UK hasn't done that since 1672, and America has never defaulted, and you don't want to go down that path. Or you're left with starting a war, where you don't really want to think about that either. So it's really a bit of a choice between or austerity, and there's just no political or public appetite for austerity. It's a vote loser. Inflation is a vote loser, but it's probably a little bit less insidious and obvious than austerity. So my personal guess would be they might go down the inflation route, and maybe that's why central banks are playing a little bit loosey-goosey with it with interest rates. You could argue US is still a little bit above target in the cut rates anyways. You try and inflate some of that debt away. So that might be an option, and maybe again that's why I showed those deficit slides, because the American needs and the UK need to get rates down to drag gilt and treasury yields down as best they can, to try and give them some breathing room on those big interest bills.
But what influence can the new president have over the Federal Reserve and the SEC?
It's a presidential appointment, the Federal Reserve, and you're appointed for a 4-year term. So in theory, Jay Powell's set in stone until I think spring 2026. The president can fire the head of the Federal Reserve, but you need good cause to do so, and you need the Supreme Court to be on your side. Now, given that the president appoints the Supreme Court, I think I'm sure you could work your way around that one. But whether you can prove that there's just cause, malfeasance, corruption, or incompetence, I would think that's probably a lot harder. I guess all you can say is if there were a US recession, or that inflation were to gallop off, then maybe Mr. Powell would be the scapegoat for that. But I think you'll have a hard time firing him otherwise. And for the SEC, same situation, presidential appointment, but Gary Gensler, I gather from Dean, not perhaps the most popular man in America right now, and he could perhaps come back to why that might be. I think he's getting a bit of flack for the lack of IPOs in the US, for example. Again, he's in till 26 or 27. Again, could be fired for just cause. You'd have to find something, but equally, it may be that if Mr. Trump were to win, Mr. Gensler would decide he might try and find something a little bit stressful to do with his time.
So, I mean, coming to you, Dean, just going back, obviously, Russ gave us a bit of an overview of the kind of quite different tax proposals between the two parties. Can you give us sort of a little insight into sort of the knock-on effect to UK businesses, perhaps, who want to do trade with the US?
Yeah, I think, well, especially, oh, go ahead, Russ.
No, go, Dean, go.
I was just going to say that, obviously we're still the largest economy in the world, and there's lots of international corporations that are still looking to invest in the States. But under the Harris tax plan, there is a lot, and Russ did talk about it, a lot of increased taxes for businesses, for high income earners, and a lot of ways that Trump had before, you know, in 2016, when Trump put through his Tax Cuts and Jobs Act, a lot of those provisions are going to expire. We know that they have an end date and they're going to expire. And under Harris's plan, there doesn't look like any way that they're going to get put back in. And so if Trump wins, he's going to try to find ways to stoke the economy. Harris has other plans.
And again, we can see
I mean,
the
what
Labour
oh,
government
go
here
on.
is talking about those national insurance increases, isn't it? Which is, so again, is a corporate levy, you could argue, of some denomination. So the debate is exactly the same here in the UK as it is in the US.
What about the impact it might sort of have specifically on sort of R&D and tech heavy sectors?
Yeah, that's something for sure. You know, Harris has talked about raising the corporation tax rate. A lot of those companies are C corporations, and she has said that she wants to raise that tax rate. That could make it a little bit more challenging. Additionally, there's been provisions for investments in R&D and depreciation to be, you know, write-offs for the tax code. Those could potentially get eliminated. So it would just be harder. She wants to raise the corporate tax rate to 28%. And the minimum tax for large corporations could, you know, go to 21%. So that becomes tough. Trump wants to reduce the corporate tax rate to 20%. So you just see that, and then what does it do? The funny thing is that Russ, and your slides say that under Democrats the economy does better, and so we just have to reconcile all this information.
Yeah, it's intriguing. I mean, I think one question I get occasionally is, what does it mean if Trump were to win? What would it mean for the Inflation Reduction Act, which from this side of the Atlantic has been seen as a positive fiscal stimulus program that's helped US growth relative to where the UK has been. Intriguingly, you know, having done some digging, it looks as if a lot of the Inflation Reduction Act money, the dollars, are actually being spent in red states, in Republican states, and a lot of it's embedded in the tax code now. So, and given that President Trump, ex-President Trump, has got support from a chap called Musk, who's got a pretty big renewables and electric vehicle agenda of his own, I do wonder whether the IRA might, you know, perhaps not get as vicious a treatment under a second Trump presidency as some might expect.
Dean, I mean, thinking about your clients, what steps are you seeing them take now in anticipation of the election results?
Yeah, Esther, everybody is planning like crazy, just on a personal level, right? The amount of estate planning and tax planning for generational wealth transfer. We know that there's a large population that is retiring and passing on generational wealth from, you know, one generation to the next. The amount of tax planning that is happening right now is substantial. Right? Everybody is trying, because we know that we have tax code that is going to expire. So everybody's thinking, okay, what can I do now? And, you know, how do I limit my potential, you know, tax quote unquote bills in the future? Esther, the other thing that people are thinking about is, if we know that my tax bills could go higher in the future, well, then how do I maximize my income possibilities out of my business as much as possible? So it's that if taxes are going to go higher, then I better make more money. I better make my business as successful as possible. And then it goes back to, how do I operate my business as best I can in this efficient environment? How can I create or leverage technologies to possibly grow our income?
Yeah, absolutely. It'll be a bit of a creative accounting going on, maybe in the short term.
No creative accounting, no creative accounting. Come on. But what we do have is, how do we, like, everybody's taking that hard look of how do we grow the enterprise value of our business? Maybe we need to look at taking on investors. Maybe we need to look at different things to grow our enterprise value.
Russ, what about the sort of foreign policy implications of a Trump v Harris win with the UK sort of specifically in mind?
Yeah, I mean, with the UK specifically in mind, I think tariffs is probably the biggest and most direct one, given it's not just China that's going to be face these impositions, although China's will be the biggest by some distance. A kind of 60% blanket figures being talked about. The UK could be subject to a 10%, for example, unless there's a specific agreement struck, which, you know, I believe was one of the goals of Brexit some 7 or 8, 9 years ago. So that is one potential thing that the UK does need to bear in mind. I'm sure that the special relationship will be called into, but that is the most direct impact. Indirectly, everybody's looking at what Trump and Harris are thinking in terms of hot point areas like Taiwan, like the Middle East, like Ukraine. I guess Ukraine is probably the one where you might see the biggest divergence in policy between the two candidates, in that President Trump seems to have a pretty decent relationship with Vladimir Putin, which I don't think you can say that is the case for the Biden administration, or indeed most of the West right now. So it may be that scenario sees NATO and the EU have to take on a greater burden, spend more of their own euros, pounds, whatever it happens to be on defence. Talking to a senior civil servant last week, he dangled a statistic in front of me, which I'm desperately trying to verify, that in 1980, when Margaret Thatcher was Prime Minister, the UK spent 5% of GDP on defence and 5% on health. It now spends 12% on health and 2% on defence, which comes back to that challenge that we have in terms of balancing the books and where the money goes. And I think the US is, again, given it's spending more on interest than it is on defence, has got these issues to address as well. And that's probably why, you know, there is a bit more reluctance to get heavily involved in overseas conflict when the bill is already so big. So I think that's something that could then put further strain on European and UK spending, is if we have to put up more of our own money for security reasons.
The question come in asking if Trump wins, what impact will sort of Trump's suggested increase in import tariffs have on global trade, and could this sort of result in a trade war? And if so, what does that mean for the UK's imports and exports?
Yeah, I mean, as a historian, you look back, you know, we thankfully don't have that many examples of full-on trade wars. And the one that you always end up going back to is the 1930s, after the US introduced the Smoot-Hawley Act, and that didn't end well for anybody. It made a bad situation worse. So you can say there were extenuating circumstances, because the globe was struggling anyway in the wake of the 1929 crash and the reverberations that had, but it definitely didn't help. So I'm kind of the opinion that, you know, nobody really wins in a trade war, and America hasn't run a trade surplus since 1975, and it has continued to run a deficit despite the Trump efforts. It means that the direction of travel has been different. Mexico has benefited, Asia has benefited, China has lost out. You could argue that potentially Europe is a potential winner, but I think what the Europeans may need to do is a bit of foreign direct investment in the US to try and get around the situation to start with.
Another question about well, people leaving the US, you know, is the strength of feeling about who wins the election strong enough to cause US citizens to consider moving to another country? And if so, is the UK still considered an attractive destination, given that we're on course to ending some of our beneficial tax regimes as well, such as the non-dom tax rules?
I would say that here the conversations are not exactly around people leaving the States. But I will say this for sure. We definitely have a lot of migration within the US to various states that might be red or blue, or may have a favorable or less favorable tax position. I'm here in California. We have extremely high tax rates. But you know what? I really like it here. The weather is fantastic. I'm here in the Silicon Valley. All of the innovation and disruption is here. With that said, there's been a lot of people that have left California for other states to pursue different tax rates. I can't speak on international and if people are going to travel to other countries, but I think for sure there's a lot of migration here in the States within.
And what about a contested result? What might that mean with the UK in mind?
Oh, I guess we've had 2 contested results this century, Gore and Bush in 2000, and that went through the courts and dragged on. But I think people just seem to get on with their lives. And although the US stock market had a terrible time towards the end of that, that was more because the technology, media and telecoms bubble had burst, and there was a capex boom turned to a bust, and the economy slowed down. I don't think it was anything to do with what was going on from a legal perspective. And we clearly had the insurrection of 6th January, 3.5, 4 years ago. Again, that blew over pretty quickly. So I guess it depends on in what way is it contested, legally, physically, or otherwise, and how long does that last. But the previous 2 examples, at least, haven't caused too many ripples, you know, uncomfortable viewing as they may have been as they're provided.
And Dean, I mean, it's coming to sort of investment. Obviously, the US companies have acquired many UK companies over the years. Does either outcome of the election make outbound investment into UK companies more or perhaps less attractive?
I don't think so. I think what organizations want to do is grow enterprise value. And so wherever they have an opportunity to do that, whether it's in the States or in the UK, if it grows enterprise value, if it adds on a component to their business that they think is positive in the long term, they're going to do it.
I mean, there's been no shortage of US M&A interest from financial or trade buys in the UK this year. I mean, overall, we've had £42 billion of bids for UK listed companies that are closed or are still live. A few more have gone by the wayside, particularly a big mining deal involving BHP and Anglo American. But there's been no shortage of interest from US buyers in UK listed assets. And I guess that's partly a function of where the dollar has been relative to the pound. It's been pretty strong. And also a function of the fact that, you know, UK equities don't look particularly expensive, and the US ones, with the market where it is, they've got an active currency that they've been using to provide an equity portion to support the cash. So I can see why the direction of travel has been going one way at least.
Russ, what about other assets that could be affected by the election results, like commodities or cryptocurrencies?
I flagged gold. I know it's not everybody's cup of tea. I know that Mr. Buffett always describes it as a useless inert lump of metal, and if a Martian came down to Earth and trod on it, he or she wouldn't know what to do with it, because it's got no industrial use. It just doesn't generate any yield. It just sits there. But equally, it has been doing well, and I think part of that is down to this deficit discussion and how not just the US, but the UK. France is encountering a major pressure point right now with a new government under Michel Barnier, the former Brexit negotiator, who's trying to get, again, some austerity through. So good luck with that without the farmers going on strike. So I think in that respect, there are multiple pressure points on that. And that's, I think, there is that nagging suspicion that, you know, the finances don't look great as they are. If we do get a recession, then heaven help us, because tax income will go down and welfare payments will go up. And that will make a particularly unpleasant sandwich. So then you'd start wonder whether they just start cutting interest rates, whatever inflation's doing, or heaven forbid, going back to QE just to meet the bills. So I think gold bugs would definitely revel in that scenario. So gold is one to watch. Oil, I think oil analysts were looking at what Vice President Harris was going to say on shale and fracking, where she'd certainly offered mixed messages previously and was perceived to be anti-fracking. And therefore restricting US oil and gas supply and potentially boosting the oil price. She said no, partly because she needs all those lovely votes in Pennsylvania, which is a big fracking state. So she's kind of done away with that one, and that's given the oil price a bit of a knock, because the US is, you know, exporting this stuff for fun right now. It's a massive producer and a massive net exporter again. So they're two that you would definitely keep an eye on.
I mean, if they are sort of staring down the barrel of recession, what sort of, how deep and how long a recession are we predicting that might be, if one had a crystal ball?
Come on, Dean.
I was counting on you to answer that
question.
Okay. No, I would say this. And Russ, I'll give you some time to think longer, because I definitely want to hear your thoughts on this. But we did just have a 50 basis point rate cut here last month. And that was definitely received very well here. And people are pointing to two more. People are hoping for two more, and then maybe a pause. But then the banks are also saying that, you know, there could be potentially, they're saying, another rate cut next year, more that could total maybe even, you know, another half a point that could total. And the folks that I'm talking to here in the Silicon Valley, the CFOs that I'm talking to, the business leaders, they're all saying that if those rate cuts come, then there could be another, you know, resurgence in the IPO and M&A market, right? That would stoke the fire again. We've had very few, especially in the technology sector, very few IPOs over the last several years. And it's like so few that it's worse than 08, 09, and it's worse than the dot-com crash in 2001. So they're thinking that more of the Fed fund rate and the interest rate cuts would, you know, restoke the growth. Now, that could offset any kind of recession. But Russ, that's kind of what the sentiment is here. What are you seeing?
I understand that, and I think, again, looking at what the Treasury market is telling you, since the Fed cut, the 10-year Treasury yield is actually up, which I'm not sure is necessarily in the script. And I think that's the Treasury market getting a little bit nervous that maybe the US economy is stronger than the Fed thinks, and that actually the danger is more overheating than overcooling. We'll see, but that's kind of the message that you send slightly from the gold price in conjunction with the Treasury market. So at the moment, I think, yeah, a recession would be the biggest surprise of any that we got next year, and it would be the nastiest one of all, I think, because it again, going back to where we are with the US valuations, with corporate earnings expectations, which for double-digit earnings per share growth next year. If you did get a recession, no. I mean, even allowing for the power of AI and everything else, that would be very, very hard to achieve in a recessionary environment, and that could make it tricky for equities in the short term, even allowing for the fact that, yeah, the Fed will be proactive, it will cut, there'll be stimulus applied, and I'm sure that heaven and earth will be moved to try and keep that recession short and shallow, but it's just not what's in security prices right now at all. If anything, the scenario divergence from cooling inflation, soft landing, lower rates is more markets worrying about overheating than overcooling.
So what I just heard, Russ, and apologize, Esther, is that just that is kind of I'm hearing, maybe the one or two more cuts, but then a pause to see what happens.
I mean, that's what you perhaps. I mean, there's one. I think it's Mr. Waller, one of the Fed governors, has been kind of talking that language this week. But if you're looking at Fed futures right now, Fed funds rate, right, I think it's 5% right now. That markets are pricing in 3.25%, 3.5% by Christmas 2025.
It's exactly what I'm hearing from CFOs as well, is that they're saying 3.75 and the IPO window is open and everybody is running to capitalize on that.
Yeah, and if you think about what would a neutral interest rate be, well, very crudely, inflation at 2%, GDP growth at 2%, then a one and a bit neutral rate, probably 3 to 4% is probably about right under normal circumstances. There's a definite logic to that, for absolutely sure.
Yeah, you just said the key word though. Under normal circumstances, right, Esther? That's the hardest.
Yeah. It's never normal. Not since I can last remember. Had a question come in on immigration. So immigration seems to be a hot topic in the US election. We are thinking of setting up an office in New York. Will any immigration changes have any impact on the ease of sending our people to work in the US? Is either party more positive about immigration than the other?
That definitely immigration gets a lot of chatter here, but I think the high level comment is that it's always around illegal immigration. That's really what they're trying to curb. We always want to welcome the most talented and brightest people to the States as much as we can. With that all said, I have heard companies say that it has been hard to get talent from internationally into the States. It has been a challenge. For sure.
Questions come in. Is there any sense that Harris or the Democrats would tighten anti-money laundering laws should they win, given the sales of Trump Tower condos, more than 1,300 to shell companies and similar? I think we can assume that Trump won't should he win. Whether I was meant to read that bit out, I don't know. But anyway, are they going to tighten anti-money laundering laws?
I think that there is it feels like there's just a sentiment around, more control, tighter regulations, and in more things than the Harris plan. So if you were to say directionally, then, that would it surprise me? It wouldn't.
Another one on tackling tax evasion. So obviously Rachel Reeves' budget is expected to include significant tax collections from tackling tax evasion, and presumably the US will try to do the same. Dean, do you have any views on new measures that could be announced to tackle this area? Because the UK often follows US policy in this. It'd be interesting to hear what might be coming down the track in the US.
We actually recently completed that. There was, I think, $83 billion that went into an investment into our revenue service of hiring more agents and finding more dollars. And they said immediately one of the biggest things is they were able to collect a whole lot of back taxes kind of immediately, because people know that the enforcement investment is high. or they've kind of committed to those dollars, and maybe folks just said, hey, let's just pay whatever's owed, and they had a high collection. Now in the future, it'll be interesting to see how that continues, right? We have the high deficits and the spending and all of that, Russ. So we'll have to kind of figure that out. But they did make a very high investment in our Internal Revenue Service, and they did see an immediate spike in collections.
Two more questions left. So one has come in on very high level. Sell US stocks and funds or buy UK funds. What would you guys do?
I'll answer it this way. I was, when I started as a...
You're 50-50 chance of being right or wrong. So
yeah, no. I started. I was trained as a value guy, which, having then been given tech stocks to cover, was a huge challenge when I went from the buy to the sell side. What I would say is that, and I hinted at it slightly, when you've seen similarly in the US market right now is being driven, as Dean said, by a fairly select number of companies who are doing absolutely phenomenally in the area of AI and technology. When you've got 7 stocks responsible for 1/3 of your market cap, I'm a little bit nervous about that. That means that 7 stocks are 1/5 of global market cap.
wow.
I'm a little bit nervous about that. And the US market, the S&P 500's market cap as a percentage of the FTSE All World is at 60%, which is exactly where it peaked in 2000. So all of those things taken on, and then looking at prior episodes of similarly markets that are similarly skewed in a certain way, tech stocks late 60s, Nifty 50 mid 70s, tech stocks late 90s. The trend eventually changes. You don't quite know what's going to cause it, but it's sometimes just sheer weight of valuation and expectations. If it was me, and this isn't advice because I don't have a timing device, I would personally be using this as an opportunity to gently diversify and look for some lower priced assets, cheaper assets, just in case. But again, I haven't got a timing device, and to be fair, I would have probably said the same 2 years ago and been wrong.
The other
Dean,
side
what
of
about
that
you?
coin. Yeah, Esther, I think the other side of that coin, and I'm not giving any stock advice either,
No.
right? But the reality is that in the future, at some point, these technology companies like Microsoft and Google and the other companies like the cybersecurity companies that have to support them and all of that, we only know that we're going to have more technology in the future. We're going to have more data creation in the future. It seems that that's where we're headed, and it seems like that's going to be the case. And if so, I heard something one time that says, you think Microsoft's large today? Wait until 10 years from now. Wait till you see what their market cap is going to be 10 years from now. You're going to be blown away. So that's the other side of the coin.
Okay, right. We are 1 minute to go. So I'm going to ask the obvious final question. Where's your money? Not who you want to win, but who you think will win. You weren't expecting that one, no? Come on.
Come on, Dean.
Who's going to go first?
Oh my gosh. I don't know. It is so razor thin right now. This is not an endorsement. I don't know. You can't, it's so hard. I don't know. You can let's flip the coin. Here, I should just, if I had a coin, I'd literally flip it and tell us. I don't know. It's a coin flip.
Fair enough. Fair enough.
That's a really good. I'll go for the trifecta. I'll go for Trump to win the presidency, the Democrats to win the House, and the Republicans to win the Senate. Okay,
well, it's all been recorded, so we'll revisit it in a couple of weeks' time. See if you're right or not. Well, thank you both so much. That was fascinating. I'm sure all of our attendees have learned a lot from this session. I certainly have. So yeah, we'll find out in a couple of weeks' time what's happened and all the policies that then follow that, and obviously what Rachel Reeves has done by then as well for our budget. So thank you ever so much, everyone, for attending. Thanks to our speakers. Please do fill out the feedback form. It's super useful for helping us shape future webinars, and enjoy the rest of your day. Thank you very much. Thank you.